Howdy, Jacob here. Today we're looking at next company in our dividend yield screener, Hasbro. So first financial review, market cap 7.2, enterprise value 10.7. So a fair amount of net debt here. It has a 5.45% dividend yield. So the debt itself from long term was 1.4 back in 2012 and is now 3.7. So a bit over double, but we can see that um, it was pretty flat until roughly 2019, and then has been actually declining. Went up in 2020 and then has been declining since. Maybe they went into debt for an acquisition. It appears so. Okay, so looks like acquisition about 4.4 billion. They went 2.3 billion in debt. Um, So mostly funded by debt, and then I presume a little bit of cash as well. So or shares. So 914 million from shares, 2.3 billion in debt. Um, all right. So what's like a 5-year average? Let's see, 200 million, 680 million, 750 million, 500 million. I think we can say about 500 million. And yeah, I mean that's about 7 times their average 5-year long-term debt. I think if they can, it all just really depends when their debt expires, how comfortable lenders are with this, and where their free cash flow is looking at that point. But for now, I think that's a reasonable-ish number. Pay down dividends of 388 million. The rolling 12 free cash flow is only 242 million. In 2022 full year it was only two little under 200 million. So from that perspective, they might not be able to afford it. But again, if you look before that, we were seeing 800 million, 700 million, 500 million. So maybe just to be safe on the assumption side, I'll just cut it in half and say that their payout will be just under 200 million. Then I'd be more comfortable that they could afford that. As for margins, I'm going to push them down due to interest expense rising. Um, let's see, the business itself. So they had a big acquisition over here, which is why they increased 16%. But to me, this might be a flat business. I might assume 0%, and then for a no growth company, 10 on the P and price free cash flow. And then for margins, maybe I'll go a little higher than what it's been like very recently, but not as high as what it's been historically. So I might be pushing for maybe 5-7 share change, 1%. All right. So right now it's not looking like I'm going to be jumping at this anytime soon. I'm seeing a price fall of 72%. This isn't the dividend yield screener, and my first assumption was to cut the dividend in half. It's still a 2.7 percent dividend yield, so it's not like it's nothing. And they have historically had a dividend for quite a while, but it's just going to be really: is this worth looking at now, or do we think that the the business has changed enough to where they might not be able to get back to double-digit earnings margins and cash flow margins? So for now, I'm just waiting, and hope everyone has a good rest of the day. Thank you.